Hi everyone, welcome to another episode of the Patient Wallet channel. Today I will be going over 6 stocks that did not participate in this year's rally. 5 out of the 6 stocks have a negative year-to-date return and underperform the market by 30% or more. The market is at an all-time high with historically elevated PE ratio, but it is important to continue to search for high-quality, undervalued companies. Like this video to help us reach as many people as possible and subscribe to the channel to see more videos like this one. As always, before you take any financial decisions, please do your own research. Let's jump straight into the video. To start, let's look at the portfolio. The portfolio value sits at £12,800 as I am recording this video. The return is 9.2% or £1,082. The allocation is 31% in Amazon, 30% in Alphabet, 17% in S&P Global, 12% in Adobe, and the remaining allocation is in Fair Isaac. Over the last 2 weeks, I invested an additional £2,500. £1,300 went into Amazon, £700 went into S&P Global, and £500 in Adobe. As the market continues to be volatile and provides me with opportunities to buy stocks that have high conviction, I am adding more into these stocks. Even though the market is at all-time highs, I feel very comfortable owning these companies over the longer term. The plan is to continue to look for high-quality, undervalued businesses to invest in and grow this portfolio to 6 figures and beyond. I will share the good and the bad on this channel transparently, so make sure you subscribe to the channel to follow along in this journey. Okay, let's look at the 6 stocks that underperform the market and I believe are worth looking into. Keep in mind that the S&P 500 return year to date is 15% as I'm recording this video. Stock number 1 is Adobe, which is part of my portfolio. Adobe operates a diversified software company worldwide. It operates through 3 segments: digital media, digital experience, and publishing and advertising. The digital media segment offers product, services, and solutions that enable individuals, teams, and enterprises to create, publish and promote content, and Document Cloud, a unified cloud-based document services platform. Its flagship product is Creative Cloud, a subscription service that allows members to access its creative products. I'm not going to spend too much time on Adobe as I published a video in the past. A link will appear on the screen for that video. The year-to-date return is a negative 20%, and the reason the stock is down is the market narrative that AI is killing software businesses. I think the market narrative is wrong. Adobe is layering AI across all their products, and they have seen increased retention as they are layering AI, which means this strategy is working fine at the moment. Okay, let's look at the stock price, fundamentals, and valuation multiples. The company trades at around $353. You could have bought the company around the same price back in February 2020, as the price was back then $345. However, fundamentals and price multiples have changed significantly. Trailing PE went from 52 times to now 22 times. Free cash flow yield went from 2.6% to now 6.5%, sitting at an all-time high. Revenue per share went from $21.8 to $53.5, a 2.5 times increase. Diluted EPS went from $6.6 to $16, increasing by 2.4 times. And free cash flow per share is sitting at an all-time high at $22.2. Meanwhile, as the stock price continued to decline, management kept buying back shares, reducing the weighted average shares outstanding on a diluted basis by 11.6%. I think this chart layering the stock price in light blue with the free cash flow per share in yellow shows that there is a disallocation that started back in November 2024 as the free cash flow went up whilst the stock price decreased significantly. Free cash flow per share went from $14 to $22, whilst the stock price went from $570 to $353. Okay, let's look at what bulls and bears say. Adobe is the de facto standard in content creation software and PDF file editing, which are categories it created and still dominates. Shift to subscriptions eliminates piracy and makes revenue recurring while removing the high upfront price for customers. Growth has accelerated and margins are expanding from the initial conversion inflection. Adobe is extending its empire in the creative world from content creation to marketing services more broadly through the expansion of its digital experience segment. This segment should drive growth in the coming years. What do bears say? Momentum is slowing in Creative Cloud after elevated growth driven largely by the model transition to software as a service. Digital experience is an emerging space and one that Adobe neither created nor dominates. Growth could be slower than we anticipate or margin expansion may not materialize. Digital experience has been built largely through acquisition. This raises the possibility of disruption from inadequate integration efforts and lends credence to concerns that Adobe may overpay for increasingly large deals. My thesis is, as long as fundamentals continue to grow and management continues to execute, the market sentiment will change, leading to a re-rating of the stock. Stock number 2 is Salesforce, ticker symbol CRM. Salesforce provides customer relationship management technology that brings companies and customers together worldwide. Its Customer 360 platform empowers its customers to work together to deliver connected experiences for their customers. The company's service offerings include sales to store data, monitor leads and progress, forecast opportunities, gain insights through analytics and relationship intelligence, and deliver quotes, contracts, and invoices, and service that enables companies to deliver trusted and highly personalized customer service and support at scale. The company's market cap is $228 billion. The trailing PE is 34.8. The forward PE sits at 20.1 times. The company has a net cash position of $3.6 billion, pays a small dividend of 0.7%. The 3-year revenue CAGR sits at 10.4%, the 3-year diluted EPS CAGR sits at 133%, and the year-to-date return is a negative 27.6%. The narrative here for CRM is that AI is disrupting the software industry and CRM is a victim of that narrative. Okay, let's look at some fundamentals, price multiples, and the stock price. As I'm recording this video, CRM stock trades at $240 and you could have bought the stock at around the same price from back in November 2020. Since then, price multiples have declined and fundamentals have increased substantially. Trailing PE went from 61 times to now 34.8 times. Free cash flow yield went from 1.7% to 5.5%, close to all-time highs. Revenue per share went from $22 to $41, almost double. Diluted EPS from $3.8 to now $6.9, an increase of 1.8 times. And free cash flow per share went from $3.9 to $12.9, sitting close to all-time highs and increasing by 3.3 times. The number of shares outstanding increased until July 2022, but subsequently management is doing share buybacks, reducing the number of shares over time. Okay, now let's look at what bulls and bears say. Salesforce dominates sales for automation but still only controls 30% in a highly fragmented market that continues to grow double digits each year, suggesting there is still room to run. The company has added legs to the overall growth story, including customer service, marketing automation, e-commerce analytics, and artificial intelligence, and management is likely going to focus on expanding margins after years of subscale profitability. And bears say, as the company grows larger, it may be increasingly difficult for Salesforce to grow faster than its various end markets. Salesforce has entered new areas via acquisition and has arguably paid material premiums in this process. Integration risk is real, as is the risk of increasingly large, dilutive, or ill-conceived deals. The company's generative AI strategy has been a series of fits and starts, and while Agentforce looks promising, it may be just another iteration in an evolving approach. So similar to Adobe, I think if management continues to execute and showcase that Agentforce is a real growth driver, the sentiment will change and the stock price will re-rate. The reason I don't own CRM at this point in time is because I have the exposure of the risk that AI is killing software businesses through my Adobe investment. As the portfolio grows, I will become more comfortable increasing my exposure to that market narrative as long as I have high conviction on company fundamentals and management execution. Stock number 3, it's Amazon. This is my largest portfolio position as I am recording this video, and I made a video on why I think Amazon stock doubles from here, so I'm not going to dwell too much on Amazon. Year-to-date return is 1.3%, significantly underperforming the market and its peers. I believe Amazon's underperformance comes from the fact that they are undergoing a CapEx cycle. On this chart, we have CapEx for Amazon in red, Microsoft in blue, Google in orange, and Meta in purple. And as we can see from the chart, Amazon spent considerably more than its peers when it comes to CapEx. The market is looking for short-term returns, whereas management is playing a different game, is playing a longer-term game. And I think shareholders stand to benefit from these massive investments today. There is a 30-minute video that I made last week explaining why I think Amazon stock doubles from here, so go and check that out. Next up, we have United Health Group. United Health Group operates as a diversified healthcare company in the United States. It operates through 4 segments: United Healthcare, Optum Health, Optum Insight, and Optum Rx. The United Healthcare segment offers consumer-oriented health benefit plans and services for national employers, public sector employers, mid-sized employers, and businesses. Healthcare coverage and well-being services to individuals age 50 and older, addressing their needs for preventive and acute healthcare services, as well as services dealing with chronic diseases and other specialized issues for older individuals, Medicaid plans, children's health insurance, and healthcare programs. Essentially, UNH is a large, diversified healthcare company. The market cap is $329 billion. The trailing PE multiple sits at 15.7 times, and the forward PE at 22.7 times. 3-year revenue CAGR is 11.3%. 3-year diluted EPS CAGR is 6.5%. The company has a net debt balance of $50.6 billion and pays a dividend with a dividend yield of 2.6%. The year-to-date return is a negative 26.8%. And as we can see from the stock price chart, problems started back in April 2025. A quick summary of what the problems were. In April 2025, United Health reported lower than expected earnings and cut its annual profit forecast, citing higher medical costs and exceeding expectations in Medicare Advantage demand. The stock fell over 20% in a single day. The company missed revenue and earnings expectations in both April and July 2025 reports, impacting investor confidence. Rising medical costs and margin compression. The primary driver was a worsening medical care ratio, which reached 89.4% in Q2 2025, a significant surge from the previous year. This indicates the company is incurring more in medical claims than anticipated, while premiums haven't kept pace with soaring healthcare expenses. The operating margin also decreased from 8.8% in 2022 to 7.3% over the past 12 months. Earnings guidance collapsed. The adjusted earnings per share forecast for 2025 was drastically reduced from around $30 to $16 per share, a nearly 47% decrease. This is clearly reflected in the stock price decline since April 2025. The stock bottomed at around August 2025 at a share price of $238. Now it's trading at $368, and I think there is a good reason for it. The mistake is reversible. Management has talked to this in their last earnings report. In response to these rising costs, the company is implementing a comprehensive set of actions focused on margin recovery and operational discipline. For 2026, the Medicare Advantage pricing strategy assumes a trend approaching 10%, incorporating factors like fee schedule changes and higher yields from provider coding. This includes significant adjustments to benefits and the difficult decision to exit plans serving over 600,000 members, primarily in less managed PPO offerings. Optum Health plans to cease arrangements for approximately 200,000 patients in fully accountable PPO products and is increasing rates to reflect higher risk profiles. Commercial pricing will dynamically anticipate higher trends into 2026 and 2027, with group fully insured pricing reflecting trends above 11%. Across all segments, remediation actions include stepping up audit, clinical policy, and payment integrity tools to identify waste and abuse, shifting to narrower networks and focusing on more disciplined managed products. Optum is driving a more concentrated and regional operating model and expects to deliver almost $1 billion in cost reductions for 2026. Furthermore, the company is scaling AI efforts across health plan operations to improve service experiences and drive cost savings, while actively engaging with state partners for immediate and more regular Medicaid rate updates. These strategic and operational changes are expected to steadily improve performance. While continued pressure is anticipated for the remainder of 2025, meaningful improvements in operations and earnings growth is projected for 2026, albeit with a longer path to recovery in the value-based care business. Essentially, what management is doing here is cost reductions and price increases to expand margins and increase profitability back to historic levels. If you believe that the management will be able to execute these changes and achieve the profitability in prior years, then the stock should rate, suggesting a 55 to 60% increase in stock price from these levels. Lastly, let's look at what bulls and bears say for UNH. United Health's strategy of providing medical insurance, pharmacy benefits, and healthcare services should create a powerful alignment of incentives to help clients control their healthcare costs better than pure-play competitors. As the leading provider of Medicare Advantage plans in the US, United Health should benefit from ongoing demographic shifts and the increasing popularity of these plans amongst seniors. United Health has managed its balance sheet more conservatively than peers, which should give it more financial flexibility during uncertain periods like the current environment. And what bears say, regulatory scrutiny appears targeted specifically at United Health, with ongoing antitrust investigations, questions around its risk assessments in Medicare Advantage, and scrutiny of its coverage denial rates in focus. The insurance and PBM industries will likely remain targets of regulators aiming to increase health coverage and reduce the healthcare cost burden on society until the US achieves universal, affordable coverage. The law of large numbers may eventually catch up to this healthcare behemoth, making its 13 to 16% earnings growth goal difficult to achieve in the long run. I think if you are a believer that management can execute the strategies they announced last quarter, then the stock returns to historic levels and there is a 50 to 60% upside from here. Stock number 5, Evolution AMZN. Evolution AMZN develops, produces, markets and licenses live casino and slots solutions to gaming operators primarily in Europe and the United States. The company runs the game from a casino gaming table which is streamed in real time, and end users make betting decisions on their devices such as computers, smartphones, tablets, etc. Its portfolio of online live table games primarily includes live roulette, blackjack, Super Sick Bo, Dragon Tiger, Craps, Live Casino Hold'em, 3-Card Poker, and Ultimate Texas Hold'em, and operates approximately 1,000 tables. The company was known as Evolution Gaming Group AB and was founded in 2006 and is headquartered in Sweden. Their market cap is 147 billion Swedish crowns. This is the equivalent of 15 billion US dollars. Currently trades at a trailing PE of 11 times. Their forward PE is 11.7 times. They have a net cash position of 415 million euros. Their 3-year revenue CAGR is 21.7%, their 3-year diluted EPS CAGR 21%, and they pay a small dividend of 0.4%. Their year-to-date return is a negative 16.1%. Over the last 3 years, their trailing PE went from 22.5 times to now 11.4 times, which is historically low. Free cash flow yield went from 4.3% to now 9%, which is historically high. Meanwhile, revenue per share CAGR was 14.4%, diluted EPS CAGR 6.7%, and free cash flow per share CAGR is a marginal 0.2%. Now you might ask, why this drop in free cash flow per share? Evolution AB management's proactive steps to address regulatory and operational issues have significantly impacted the company's revenue and cash flow. These actions have led to a near-term slowdown in revenue growth and compression of profit margins. This was also extensively discussed during their last earnings call. Evolution is proactively implementing ring-fencing measures across European markets to align with evolving regulatory landscapes. This strategy ensures that their games are exclusively available through locally licensed operators where such regulations exist. While intended to enhance competitive advantage and prepare for future shifts, these measures have led to a short-term financial impact. Revenue in Europe for Q2 25 decreased by 5% quarter-on-quarter to 180.2 million euros, a stronger effect than initially anticipated, driven by the full quarter impact of these changes and varying levels of market channelization. Dialogue with the UK Gaming Commission is ongoing regarding the regulatory review. Despite the immediate revenue impact in Europe, the company views regulation as a market driver and continues to support regulators. This proactive approach is designed to increase their competitive edge. Beyond Europe, Evolution is actively expanding its presence in other regulated markets. In Asia, the launch of its first studio in the Philippines serves the newly licensed iGaming jurisdiction, contributing to the region's 4% sequential growth. North America is characterized as a healthy and predictable regulated market, demonstrating robust year-on-year growth of 23%. Similarly, Latin America, particularly Brazil, is seen as a market with vast potential, where a new studio has been opened to capitalize on the recently regulated environment, with actively expected to pick up as adoption occurs. The company acknowledged that while these self-imposed stricter ring-fencing measures and ongoing issues in Asia have led to a slower financial start to 2025, they are laying a necessary foundation for sustained future growth and increasing their distance from competitors by proactively adopting to and shaping regulated market environments globally. Management actions are impacting the company's fundamentals, as we can see free cash flow and diluted EPS being hit in the last 2 quarters. However, at a price multiple of 11 times and a free cash flow yield of 9%, this stock looks attractive. Moving to the last stock, we have Copart, ticker symbol CPRT. Copart provides online auctions and vehicle remarketing services in the United States, Canada, UK, Brazil, the Republic of Ireland, Germany, Finland, the United Arab Emirates, Oman, Bahrain, and Spain. It offers a range of services for processing and selling vehicles over the internet through its virtual bidding, third-generation internet auction-style sales technology to vehicle sellers, insurance companies, banks, charities, fleet operators, dealers, vehicle rental companies, and individuals. The market cap sits at $42.8 billion, the trailing PE at 28 times, the forward PE at 26 times, the 3-year revenue CAGR is 9.9%, the 3-year diluted EPS CAGR 12.1%, and the company has a net cash balance of $4.7 billion. The company's year-to-date return is a negative 20.3%, and the problem started back in May 2025 where they missed earnings. Let's look at the stock price multiples, and fundamentals. The stock price trades close to $45. Bought the stock back in May 2023 close to the same price. Since then, the trailing P multiple went from 33 times to 28 times. Free cash flow yield went from 2.3% to 2.8%. Revenue per share CAGR sits at 9.3%. Diluted EPS CAGR at 13.9% and free cash flow per share CAGR at 16%. Meanwhile, management has been marginally diluting shareholders as the weighted average shares outstanding on a diluted basis increased by 1.3% between April 2023 to July 2025. I will leave you with the Morningstar report for Copart as it's a report from September 2025. Copart earnings, strong pricing battles unit declines while cash continues to accumulate. Copart stock fell nearly 3% in September 4th after hours trading, despite fourth quarter fiscal 2025 diluted EPS growing 24.2% year over year to $0.41 and beating the $0.36 consensus. Global units sold fell 0.9% on US weakness. Why it matters? Copart's stock has been under pressure for most of fiscal 2025 and we think the market was looking for better unit growth. Assignments, sellers giving a vehicle to Copart to sell, fell by a low single-digit %, which suggests further volume declines in fiscal 2026. We think the market should focus more on Copart's vast liquid digital online auction platform and the pricing growth it brings than just volume. The firm's global average selling price rose 5.6% on similar growth from the key US insurance customer base. Pricing growth that exceeded changes in industry used vehicle pricing also drove 14.8% operating growth. Operating margin increased 310 basis points to 36.7% on 12.4% gross profit growth, while free cash flow of $350.8 million constituted a healthy 31.2% of revenue. The bottom line, we are leaving our Copart White Mode rating in place as well as our $57 per share fair value estimate. However, we will reassess all valuation inputs once we roll our model forward for the yet to be filed 10K. We think auction volume declines are mostly a function of insurance customers' policy writing growth rather than the long-term problem with Copart's mode, so we expect eventual volume recovery. US volumes were only down 0.6% when adjusting for more direct buy business. Copart's cash and investments are $4.8 billion, up from $3.4 billion at the end of fiscal 2024. CEO said on the call that buybacks will be the long-term means to return cash to shareholders, but we think that should happen now to at least offset dilution from stock compensation. And let's see at what bulls and bears say. We see Copart's White Mode as safe, given minimal competition and an excellent ability to provide a high liquidity marketplace for buyers and sellers. Copart's balance sheet looks to be in great shape and we expect buybacks as well as acquisitions. The latter is more likely to help fuel stock price growth over time. Copart's auction volumes should rise as used vehicle pricing caused by the chip shortage comes down, while repair costs should remain high. These factors should encourage insurers to total more vehicles than in recent years after the pandemic and the chip shortage. And what do bears say? Copart's mode could be weakened should RB Global meaningfully improve IAA following its March 23 acquisition, but we are not concerned this will happen. German market growth could take time as title transfer laws are different and more cumbersome than in the US. And lastly, if cash constantly piles up, it begs the question of when will it be spent and will shareholders get any of it. So these are the 6 stocks that I think are worth looking into. I'll continue to look for high quality undervalued businesses, and if I build conviction, I'll end up investing. Let me know if you like this type of content in the comments below, subscribe to the channel, and I'll see you in the next one.